After a very long wait, it is finally here, the Q3 Canadian bank stock comparison video that I know so many of you have been patiently anticipating. As of around last week, all these bank stocks released their Q3 figures except for Laurentian Bank. That released theirs last Friday, so that's why I was holding off a little bit here, but the time has now come to see how this industry has fared amidst this period of low interest rates. Hey, what's going on, savers and investors? I hope you're all having a great day as always. If you're new to the channel, then welcome. My name's Griffin, and on this channel we speak about all things investing, from stock market news, specific company analysis, real estate, and more. So if you're looking to grow your wealth through investing, then make sure to subscribe to the channel and hit the bell button so that you're notified whenever I release new content. In today's video, we're going to be diving into an Excel spreadsheet and comparing the Q3 numbers of not 5 but 7 Canadian bank stocks that have been requested by the audience. We now have the most up-to-date financial information about each one of these 7 banks, and we'll be able to determine which ones show the most signs of promise from a quantitative standpoint. Canadian bank stocks remain one of the worst hit industries in the Canadian stock market, with most of them plummeting more than 30% in March, creating some insane value deals for dividend investors. But with that said, most of them have been slowly creeping back up over the past 6 months. I'd also like to mention that this comparison video is not going to take into account business or qualitative factors. Rather, we're going to be sticking strictly to the financial information for each one of these 7 banks. By the way, for any American viewers watching this video right now, even though these are Canadian bank stocks, they are all dual listed on American exchanges. So if you're interested in purchasing any of them, then you can find these on an American exchange also. And as always, if you're new to investing and still need to open up your very own brokerage account, then make sure to check out one of the 2 links down in the description, where you can open a Quest Trade or a Wealthsimple Trade account and get free money for doing so. With that said, we have a lot of information to go over today, so let's dive right into the Excel spreadsheet. And if at any point in time you're enjoying this video and it provides you value, please take 2 seconds to drop a like. It really helps my channel out. Alright, so jumping into the Excel spreadsheet, a couple things to mention before we go any further. This is a bank stock comparison between TD Bank, Royal Bank of Canada, Scotiabank, Bank of Montreal, CIBC, and then 2 new ones being National Bank and Laurentian Bank. All numbers are for Q3 2020 unless otherwise specified to be from Q1 or Q2, and all the values are in millions of dollars unless they are percentages or ratios. Let's start off at the top with the current market cap of each one of these stocks, and note that this is as of September 5th, which is a Saturday evening while the markets are closed, and you'll most likely be watching this video on Sunday the 6th of June, so all prices will be the same. I also want to mention that for each metric that we're going to be looking at, we'll be going from left to right, starting with TD and then finishing at Laurentian Bank, just to keep things orderly. So starting with TD Bank, their current market cap is the second largest of the bunch at $114.923 billion, with a share price of $63.42, which is still down 18.40% from the 52-week high price point, which happened to be in February, as with every other one of these bank stocks. Royal Bank of Canada remains the largest bank stock in Canada at a market cap of $137.825 billion and a share price of $96.91, which is slowly creeping back up but is still down 11.64%. Scotiabank has a market cap of $67.041 billion, making it the 3rd largest bank in Canada with a share price that is still down a whopping 27.91%, placing it as by far the worst performing bank stock of the Big 5, even after Q3 earnings announcements. Moving on, Bank of Montreal has a market cap of $52.305 billion, making it the 2nd smallest of the Big 5 in Canada. Next up is CIBC, that has a market cap of now $46.425 billion, which remains a 10.24% down from that 52-week high. And finally, we've added 2 new stocks to this analysis video, being National Bank and the Laurentian Bank, both of which are significantly smaller in terms of market cap and overall revenues, with Laurentian Bank being pretty much the worst performing bank stock in the industry, so we'll uncover why that is when looking at the financial data. Most of the bank stocks have actually even been performing quite well since the bottom price points that we experienced in March, when investors were extremely bearish on the future outlook of bank stocks in general, as interest rates were slashed down and there was a general worry regarding the scope of loan defaults resulting from incredibly high unemployment rates. Now, the interest rates do, however, remain quite low even through Q3 in the Canadian market, but interestingly, revenues are actually seeing an increase since Q2, and these stocks are rebounding happening as investors are pleasantly surprised by the unexpected Q3 earnings. Let's now move on from the market cap valuation of these banks to dig into their Q3 financials, which should give us some further insight into why the outlook of bank stocks seems to have changed since Q2 and whether or not they are still expecting massive loan defaults. As you can see, I've included the revenues from both Q2 and Q3 with a percentage change for each of the banks to shed some light on the revenue fluctuation quarter over quarter, even though interest rates have remained quite low. Obviously, percentages that are color-coded in green mean an increase and in red mean a decrease. TD Bank's revenues for Q3 were $10.665 billion, which is actually up 1.3% since Q2, and surprisingly, it is the best quarter ever recorded for this bank. Honestly, I don't think anyone was really expecting this type of growth amidst the current market environment, but as a TD Bank shareholder, I'm definitely pleased to see this. Moving on now to the Royal Bank of Canada, their income for Q3 was a massive increase from Q2 to $12.920 billion, which is up a staggering 25% since Q2 2020, mostly as a result of increased non-interest income, including insurance premiums, investments, and fee income. This type of growth quarter over quarter for a bank stock is almost unheard of, especially for the largest bank in Canada, and the stock price has definitely followed suit, sitting now at only 11.64% under the 52-week high. Honestly, these are unreal figures that are showing investors that Royal Bank is a powerhouse in the Canadian bank industry, showing resilience and growth even amidst this difficult period. On the other hand, Scotiabank's revenues are severely trailing behind at $7.734 billion, still down 2.79%, which is one of only two banks that hasn't seen growth since the last quarter, explaining why the stock has performed so poorly in contrast to the industry. Now, as of Q2 figures, I actually recommended Scotiabank as my second bank stock pick, but man, these figures are very underwhelming, and for now, I'm not impressed with what I'm seeing, but we're going to see if things get a bit better when looking at the following financial info for Scotiabank. As of the last bank comparison video on Q2 numbers, BMO had been the hardest hit bank from a revenue standpoint, contributing to how poorly the stock was performing. But now, as of Q3, total 180, we're seeing the highest growth on the list here at 36.5% growth quarter over quarter. Similarly to the Royal Bank of Canada, their interest income is slightly higher, but where this massive growth is coming from is non-interest expenses such as trading fees and insurance fees. Quickly covering the last three banks here, CIBC's revenues have seen a 2.84% growth, which is nonetheless still definitely nice and healthy to see. National Bank had some difficulties with the worst revenue fluctuation of the bunch, down 3.34%, and then by far the smallest bank on the list, being Laurentian Bank, has seen 3.5% revenue growth. All in all, across the Canadian banking industry, I'm actually very surprised and quite impressed by how these banks have rebounded from a revenue standpoint, and I was honestly anticipating somewhat flat growth across the board. With that said, let's now see how this is translated over to the net income figures. Starting with TD, their net income for the quarter was $2.248 billion, which is significantly up since Q2, but even with increased revenues, the main reason for this is due to their decrease in provisions for credit losses, acronym PCL. Provisions for credit losses are basically cash that the bank is putting aside in order to account for future potential defaulting on their loans loaned out to customers. You can think of this as money that the banks have been putting aside to account for future potential losses in revenues as a result of their customers defaulting on loans, and this PCL figure is deducted from their revenues, so that's why it has an impact on the net earnings. As a side note, we can see on this row right here that most of these banks, except for, well, Scotiabank, have actually significantly reduced their PCL since Q2 2020, meaning that they are most likely interpreting the current market environment as being less at risk of massive loan defaulting because they aren't focusing as much towards it. This is good news as an investor that across the board, these banks seem to all be thinking the same way. I'm not going to go through the net income of each and every bank, but universally we're seeing significant decreases in PCL figures, and this is having a major impact on the net income of each one of these banks. Moving on to the next set of rows, this is sort of like the balance sheet section where I've included some relevant information regarding their financial position that we could have been looking at in another company analysis video. In order, we have the liquid cash position of each bank as of July 31st, 2020, followed by the assets and liabilities, and finally we have the bank-specific CET1 ratio that we'll be speaking about. FYI, for this block of data, numbers in green mean that the cash or assets position have gone up since Q2 2020, and red mean that they have gone down. The bank with the most liquid cash as of Q3 is once again CIBC with 212.766 million, and the bank with the least amount of cash, unsurprisingly, is Laurentian Bank due to their significantly smaller size at only $462.1 million in cash, which happens to also be a decrease since their last quarter. From the big five though, Scotiabank has seen a huge decrease in cash position down to 59.041 billion, making it the least liquid of the bunch, and BMO has managed to increase their figure by nearly $5 billion. TD remains the second most liquid of the big five. Alright, so let's now speak about the total assets of each bank. And again, I'd like to reiterate what constitutes an asset and what constitutes a liability in regards to a bank, because this is different than basically every other company that we've done an analysis on. With other traditional companies, assets include cash, property, goodwill, short-term investments, receivables, and the list goes on. However, with banks, assets are actually loans that they provide to their customers. This is because when a bank loans out money, they have entered into a contractual agreement with the borrower to receive a payment each and every month, with a portion of the payments being interest. It's really for this reason that a bank can put these loans in their asset column, because the loans generate them income regardless of what the loans are used for. Now that we understand what is considered an asset for a bank, TD and Royal Bank have almost identical total asset figures at just above $1.68 trillion. I mean, that's hard to even wrap your head around, assets above $1 trillion. The bank from the big five with the least amount of total assets is once again CIBC, but this isn't all that surprising considering that it's by far the smallest of the five, and with that said, it has grown its assets since Q2. Now, what about the liabilities for these banks, considering our definition of what an asset is? Well, if we flip the asset definition, this would make a liability anything that takes money out of the bank's pocket. In this case, this happens to be interest that they pay to customers for the money that is just sitting in their bank accounts, because think of it, if the bank has to pay a couple percent in interest on all the money that is just sitting in their customers' accounts, this is money that is flowing away from the bank, making it a liability, which is actually quite interesting if you think of it. Once again, TD and Royal Bank are almost tied in terms of total liabilities, right around 1.6 trillion, and CIBC has the least amount of liabilities of the big five at 718.883 billion. Now, aside from the fact that banks have different assets and liabilities than other types of companies, I mentioned earlier that we would be looking at a bank-specific ratio called the CET1 ratio, which divides the liquid assets of the banks by their total assets, giving us a percentage figure. The CET1 ratio is really important for a bank because, considering the fact that their loans are considered assets, the total assets figure kind of means nothing when assessing how financially strong a bank is if it were to enter a difficult financial position, because it's not like they can actually cash out these loans to customers for instant liquidity. Basically though, the higher the CET1 ratio, the better. So all these banks are actually hovering quite close to each other, with TD Bank having the best CET1 ratio at 12.5%, overtaking the Royal Bank since last quarter. Scotiabank comes in last from the big five for this ratio at 11.3%, and Laurentian Bank is significantly behind the industry at only 9.4%. If you're enjoying this analysis up to now and it's providing you value, then please take 2 seconds to drop a like on the video and subscribe to the channel for more company analysis and stock market related content. Moving on to the next block of rows, I'll try to speed through this one in order to get to the more exciting figures, but this section highlights why we even spoke about the provisions for credit losses at the beginning beginning of the video in the first place. Remember that the provisions for credit losses are funds that these banks have been putting aside to account for future potential loan defaults. As a result, this percentage represents how much the bank has already put aside and accounted for in relation to the total amount of loans and leases that they currently have out. This row above is the total amount of loans and leases net of the allowance for loan losses, and doesn't really matter though since we have the percentage of PCL in relation to net loans, but I decided to add it anyways. Essentially though, you want this ratio to be as high as possible because it means the bank has already put aside and accounted for a higher percentage of their total loans going into defaults. With that said, we've seen from the declining PCL figures that these banks are optimistic regarding the market moving forward because they aren't setting aside as much cash for potential loan defaults. This is why I've color-coded in green percentages that have actually gone down and then in red percentages that have gone up, meaning that those banks are still bolstering their PCL, and as a result, this has an impact on their net income. In this case, pretty much across the board, banks have reduced their PCL as a percentage of all net loans, meaning they are optimistic on lowered potential future defaulting, except for, well, Scotiabank once again, that has increased this figure. The reason why this is important to mention is because considering the fact that banks generate a high percentage of their income from interest, well, if the baseline interest rates remain low as we're experiencing right now, and for what is forecasted, well, these banks could see stagnation or even decline in revenues derived from interest income. So with this in mind, a bank that has a lower percentage of income being derived from interest income is favorable in our current market environment right now. And this actually brings me to the next section where we compare the percentage of income that's being derived from interest to the income generated from non-interest sources. By the way, non-interest sources mostly represent banking and administration fees. TD Bank has managed to actually lower their percentage of interest income since Q2, which is somewhat expected due to the lowered baseline interest rates, but let's remember that they increased their top line. Royal Bank is well positioned here at a significant increase in non-interest income, placing their current interest income at only 40%, even considering their explosive revenue growth. This is great to see. BMO has managed to turn things around, reducing this figure by 15%, and the worst position of the bunch is Laurentian Bank at nearly 70% of their income being generated from interest, which could completely jeopardize them in the future as interest rates remain low. In fact, they are also the least bolstered in regards to their provisions for credit losses, even though they're the bank that derive the most of their income from interest. Alright, so we've pretty much gone through all of the main financials and metrics for these banks, and now we'll be speaking about their current value and dividend yield to see whether or not these are still good dividend stocks to add to your portfolio, and I'll be sharing my thoughts about which of these banks are best positioned right now. These three rows contain the current trailing 12 months price to earnings of each of these banks, and I've gone ahead and actually calculated the average 5-year price to earnings of each one to determine whether or not these companies are currently trading at a discount from an earnings standpoint. I'd also like to mention and remind you that the net earnings are somewhat skewed right now, as we determined earlier, due to the provisions for credit losses, but nonetheless, this really gives us a good idea of what's going on here. Starting with the largest discount, we have once again Scotiabank at a now 8.62% discount on price to earnings, and considering the fact that the share price is still down 28% since the 52-week high price, this is not surprising to me. With that said though, this does not necessarily mean that it's the best option on the list based on everything else that we just covered regarding Scotiabank. The only other banks that are trading below their 5-year average price to earnings are BMO and Laurentian Bank. Since the last analysis of Q2 figures, BMO has definitely turned themselves around and have managed to stabilize things. Even though the other banks are trading above their 5-year average price to earnings ratios, this doesn't necessarily mean that they're overpriced in my opinion, because remember that right now most of these stocks are still down 10 to 20% from their 52-week highs, and their net earnings are lower than usual as a result of provisions for credit losses, all of which have an impact on the price to earnings ratio. And last but not least, before my final thoughts and comments, let's speak about the dividends for each, because after all, Canadian bank stocks are known for their dividends, so what would this video be without speaking about their dividends? On the top row, we have the current dividend yield, with all of them being honestly quite attractive for dividend investors, even though these have gone down as share prices have risen, but regardless, very nice yields. Moving on to the dividends paid in Q3, this is the actual cash amount that the banks distributed out to shareholders during the third quarter. Now, this doesn't really say much when we just look at the cash figure alone, so the dividend payout ratio tells us what percentage of the net earnings was paid out in dividends. For pretty much all of these banks, their payout ratio in Q2 was above 100% as a result of the provisions for credit losses. Since then, as the net earnings have increased, most of these banks are now in a position where their dividend payout ratios are around or below 60%, which is much more reasonable. In addition to this, if we divide the dividends paid out during Q3 by their total cash positions right now that I personally just calculated myself and am showcasing on this last row, well, we can clearly see that the dividend distributions still only represent a tiny cash portion of these banks' liquid cash assets. And for this reason, as I had predicted, these banks have not cut their dividend except for Laurentian Bank that cut their dividend by 40%. Alright, we just covered an insane amount of data related to the financials of each one of these banks, so let me try to make some final sense out of all of this so that I can share which bank stocks I believe are the best positioned right now for future success based on the most up-to-date Q3 numbers. The Royal Bank of Canada is obviously an extremely solid pick here. Their revenues as well as their net income are up substantially since last quarter, and they have a very nice CET1 ratio, and on top of that, only 40% of their Q3 income was derived from interest. This is great for a continued low interest rate environment. In addition to this, they have a very nice cash position, and their dividend yield isn't the highest, but a 4.36% dividend yield at a 50% dividend payout ratio. You can't really go wrong with this. TD Bank is also a great pick here, even though the revenue change quarter over quarter isn't nearly as dramatic as, say, the Royal Bank of Canada, but they also have a very nice CET1 ratio, and their net income has gone up significantly since last quarter. Now, their stock price is also still down roughly 20%, meaning a nice room for future growth, and all of this with an extremely nice dividend yield that is not going anywhere due to their very low dividend to cash position percentage. Most surprisingly, since last video, I'm pleased to see that BMO is turning things around, because as of that last analysis, they were by far the worst positioned bank on pretty much all fronts. Since then, their revenues have actually seen explosive growth quarter over quarter. They've managed to bolster their cash position. Their PCL to net loans remains around 1%, which is nice. And finally, only 49% of their income was derived from interest income during this period. The stock price remains down roughly 22.3% from the 52-week highs, with a dividend yield right now of 5.17%, which is very nice, and this is at only 0.95% of their total cash position. Finally, I'm disappointed in Scotiabank's performance since my last video, where at the time the financial data about this company led me to believe that it had some nice room for growth in the short term. The revenues did not meet expectations whatsoever, and since this is the only bank of the list that we looked at today that's continued bolstering their PCL, this has had an impact on their net income, which was also nothing short of disappointing. This is also the only bank of the big five that has decreased their liquid cash position, and the only other bank on the list that did this was Laurentian Bank, but even at this, they have a very nice dividend yield above 6%, and I don't think that it's going anywhere based on the information that we looked at in this video. So what did you all think of today's analysis and my interpretation of the Q3 financials of each one of these 7 banks? I'd love to know your thoughts, so let me know down in the comments, and if you enjoyed this video, please take 2 seconds to drop a like. It really helps my channel out. The main goal of this type of industry comparison video is to put all the data side by side for the companies in a specific industry, so that yes, I can share my own thoughts, but also so that you can see what's going on in the industry and choose for yourself which companies you want to invest in based on the data. If you want to learn more about stock market investing, specific company analysis, as well as other investing topics, make sure to subscribe to the channel and hit the bell button so that you're notified whenever I release new pieces of content. So on that note, thanks a lot for watching today's video on the Q3 comparison of Canadian bank stocks, and I'll see you in the next one.